Hey everyone, and welcome to another session. So, in today's episode, we're actually going to be talking about how interest rates affect the markets. So, we're going to look at why during high interest rate periods, markets tend to perform low, and during low interest rates periods, markets tend to perform better. So, when you are actually thinking about interest rates, it's really just the cost of borrowing. So, it interest rates really just tell you how much you are going to be spending. So, whether you're looking to purchase a mortgage, to purchase a motor vehicle, or really to borrow to reinvest, then interest rates tend to really affect the overall outcome of the market. And the reason why this is so is because when interest rates are high, it costs more money to actually borrow funds. And so if there is a period of high interest rates, consumers actually tend to have less funds available. And so with less funds being available, they would tend to actually cut back on these borrowings that they would have done. So let's say that the consumers are actually interested in investing in a new house, for instance, and if interest rates are low, then more persons would naturally be willing to actually borrow, and banks would also be more lenient and so be willing to lend more persons. But as interest rates actually start rising within the markets, the banks actually tend to start scrutinizing these loans a lot more. And so when banks start scrutinizing more, it's really only the persons that are the very best at repaying that would actually get first priority, and they go down that line until they actually have met all the requirements of their sets of persons that are able, that they deem are good, credit worthy, and were able to actually repay these loans. So another reason why high interest rates really affects the markets is that when interest rates are high, stocks tend to become less attractive, and this is due to the volatility within the market. So during high interest rates, volatilities actually tend to increase, and so investors, both institutional and retail investors, they tend to move their funds from highly volatile and speculative investments and go towards safer, more attractive investments. So these investments that they move their funds from would be like the bonds, so there are the government bonds, the corporate bonds, there's the repurchase agreements, the certificates of deposits, and retail repos. So these really become more attractive, and this is just because with interest rates actually being higher, they actually tend to pay a lot. They pay looks more attractive than before, and so persons will be willing to move their funds from the stock markets into these more safer, secure types of investments where they'll be actually be guaranteed or have a much better guarantee in terms of their returns and repayments. And so when I actually worked in the financial industry, what I noticed a lot of that was happening was that there was actually a lot of borrowings that occurred within the industry. So a lot of different institutions will actually be taking out repos, and the reason why this is so is that they would actually just be needing to have some quick liquidity needs that would arise, and so the best option would be just to actually take out a repurchase agreement, or and so they'd actually take out the repurchase agreement and they'd actually get the money quickly, or they'd actually issue a repurchase agreement to actually get funds. And so there was a a lot of back and forth between the different financial institutions, and so these really affects how other financial institutions really invest. And also with the commercial banks, there is actually an interbank rate that they use. So when commercial banks, they actually have to have a reserve with the central bank. So in the US they'd be the Fed, and in other jurisdictions they'd actually be called the central banks. And so they'd have the reserves stored within those central banks, and if they fall short on liquidity, then they just borrow from another financial institution. And so once that borrowing is done and taken place, they just repay back at the end of the agreement. And so with interest rates being higher, these borrowings would actually become more expensive, and so the banks would actually need to offset these costs. And usually how they usually offset costs is through fees, interest rates. There are different methods that the financial institutions use to offset costs. However, within high interest rates though, they usually tend to pay more in terms of savings, and so savings tend to become even more attractive during high interest rates, and they can actually reach as high as 2 to 3%, which we actually had seen recently. And so with this would actually be more attractive for persons who are looking to save their funds. But with low interest rates, persons are less attracted to actually saving funds, because the repayment or the interest that they'll be getting on their funds is actually too low, and so they tend to stay clear of that. So as we tie it back now to the investments, so with high interest rates, there's actually less borrowing that would occur. And let's look at it from a corporate or an institutional perspective. Now, if with institutions, they tend to use leverage to actually increase their investments. And so if interest rates are high, then these institutions would actually be cutting back on the leverage that they would be taking within to their investment strategies. And so with leverage actually being reduced, it actually would mean that the amount of funds that would be flowing within that financial industry, within the stock market, actually would turn out to be a lot less, as institutions are now looking to be more conservative, and so they'd be moving more away from the stocks and into other assets, such as mentioned earlier, bonds, repos, CDs, commercial papers, and so forth. And actually, the interest rates have actually positively affected the markets thus far. So taking a look now at the markets, the S&P 500 actually had increased by about 2.5% since the reduction of the interest rates by the Fed, and the Nasdaq actually increased about 4% during that same period. So from September 18th to October 10th, the actual growth within the S&P 500 index and the Nasdaq index about 2 and 4% respectively, and the indexes have grown significantly from year to date. So the S&P 500 is actually up at 22%, while the Nasdaq index is up about 24% year to date. And so the interest rates really has affected these investments, and given that it's actually coming down, so the first rate cut actually had occurred September 18th. This is positive news, and so as more rate cuts start coming in the future, there will also start seeing booms and further growth within the stocks markets, because more investors and more institutions and different persons would start putting their funds back into these stock markets, and so as a result the stock markets will start growing again, the volumes and the trading activities will also start increasing. And so these are just my takes on why the interest rates are so important to the stock market. Thank you so much for watching this video. If you like it, just ask that you give it a thumbs up, leave any comments that you may have down below, and until next time, take care. Thank you. Bye.